BlackRock controls $11.5 trillion in assets. That's more than the GDP of every country on Earth, except the United States and China. More than the combined wealth of the world's 500 richest billionaires. 3 times what Elon Musk, Jeff Bezos, and Warren Buffett are worth combined, multiplied by 10. But here's what nobody talks about. BlackRock doesn't just manage money. They own pieces of virtually every major corporation you can name. Apple, Microsoft, Amazon, ExxonMobil, JP Morgan Chase, Walmart, Disney, Netflix, Tesla. They're the largest shareholder in 90% of S&P 500 companies. Think about that for a second. One firm, partial ownership in almost every major company in America. And they did it through a single product that most people have never heard of. A fund so brilliantly designed that it prints money while flying completely under the radar. No flashy headlines, no billionaire founder courting attention, just quiet, systematic accumulation of power that would make John D. Rockefeller envious. What nobody knows is how they turned a simple investment vehicle into the most powerful force in global finance. How they convinced millions of everyday investors to hand them voting rights to trillions in corporate shares. How they now sit in boardrooms across America, influencing decisions at companies that touch every aspect of your life. What you watch, what you buy, what you drive, where you bank. The craziest part? They charge almost nothing for this service. While traditional money managers demand 2% annual fees, BlackRock operates its empire for pennies on the dollar. They've made themselves indispensable by being cheap, efficient, and invisible. This is the story of how BlackRock built the most powerful secret fund in history, how they weaponized passive investing to accumulate influence that rivals sovereign nations, how they became the ultimate insider at every major corporation without anyone noticing until it was too late, and how they're using that power right now to shape the future of capitalism itself. Today, BlackRock CEO Larry Fink sends a single letter each year that makes corporate executives across America sweat. Not because he threatens them, not because he yells, but because he controls enough voting shares in their companies to make or break their careers with a single proxy vote. Fink didn't start out as a titan of Wall Street. In 1988, he was 36 years old and nursing a career-ending disaster. He'd just lost his employer, First Boston, $100 million on a mortgage bond bet that went catastrophically wrong. In the testosterone-fueled culture of 1980s Wall Street, that kind of failure typically meant permanent exile. Instead, Fink founded BlackRock with 7 partners in a tiny office, managing just $5 million in assets. The name itself was a joke, a play on black box trading and Blackstone, the private equity firm that gave them seed money. They had 4 computer terminals, basic office furniture, and a radical idea that nobody on Wall Street took seriously. Compare that origin story to where BlackRock stands now, $11.5 trillion under management, 20,000 employees worldwide, offices in 38 countries, and influence that extends into central banks, pension funds, and government treasuries across the globe. The gap between those 2 points seems impossible to bridge. What made BlackRock different wasn't genius stock picking or insider connections. It was something far more subtle and ultimately more powerful. They understood before anyone else that the future of investing wasn't about beating the market. It was about owning the market itself. Behind BlackRock's staggering rise was a product called the Exchange Traded Fund, or ETF. Specifically, their iShares division, which they acquired in 2009 for $13.5 billion in what looked like a crazy bet at the time. The financial crisis had just devastated Wall Street. Lehman Brothers had collapsed. Bear Stearns had imploded. Banks were being bailed out with taxpayer money, and Larry Fink was quietly positioning BlackRock to dominate the next 40 years of finance. This wasn't just about making money, though they've done plenty of that. This was about fundamentally reshaping how capitalism functions, about creating a system where one firm could exert influence over thousands of companies simultaneously without technically controlling any of them, about building power through passivity, dominance through delegation. Let me take you back to the mid-2000s. The financial world was in the midst of a transformation that most people couldn't see coming. For decades, investing had been active. Skilled managers picked stocks, charged high fees, and promised to beat market returns. Mutual funds dominated. Financial advisors pushed proprietary products. Wall Street printed money on complexity. But a quiet revolution was brewing. Index funds, simple portfolios that tracked market benchmarks like the S&P 500, were gaining traction. They were boring, unsexy. They didn't promise outsized returns or employ brilliant analysts. They just mechanically bought shares in every company in an index and held them forever. The pitch was simple. Since most active managers fail to beat the market after fees, why not just buy the whole market for cheap? BlackRock saw something others didn't. They saw that if you could make index investing efficient enough, cheap enough, and easy enough, you could hoover up trillions in assets. Not by being smart, by being inevitable. By offering a product so low cost that it became irrational not to use it. By making passive investing so dominant that money would flow to you automatically, like water running downhill. The genius was in the mechanism. ETFs traded like stocks, but held diversified portfolios like mutual funds. They were tax-efficient, liquid, and transparent. But most importantly, they aggregated voting power. When you bought shares in BlackRock's iShares S&P 500 ETF, you weren't just getting exposure to 500 companies. You were handing BlackRock the voting rights to your shares in all 500 of those companies. Individually, that meant nothing. But when millions of investors did the same thing, suddenly BlackRock controlled the votes on trillions of dollars in corporate equity. They became the largest shareholder in Apple without picking Apple. The largest shareholder in ExxonMobil without analyzing energy markets. The largest shareholder in Bank of America without understanding banking. They just bought everything, held everything, and accumulated proxy voting power on a scale never before seen in capitalism. What most people don't know is that this wasn't an accident. It was engineered. BlackRock built sophisticated technology, their Aladdin risk management system, that allowed them to manage this complexity at scale. They cultivated relationships with regulators who viewed them as stabilizing forces after the 2008 crisis. They positioned themselves as the solution to every financial problem governments faced, and they did it all while maintaining the image of a boring, responsible asset manager. No scandals, no insider trading, no flashy hedge fund billionaires buying sports teams. Just steady, relentless growth fueled by a product that seemed too simple to be dangerous. But to understand how BlackRock built this empire, we need to go back to the beginning, to a young Larry Fink learning hard lessons about risk, to the early days when BlackRock was fighting for survival against giants like Fidelity and Vanguard, to the moment when they made the acquisition that would change everything. This is how one firm went from managing $5 million to effectively owning Wall Street itself. Chapter 1. Quiet Beginning. Larry Fink learned about devastating failure in the spring of 1986. He was managing First Boston's bond trading desk when interest rates moved against him in ways his models never predicted. The loss came fast. $100 million evaporated in weeks. For context, that's equivalent to roughly $280 million in today's money. His reputation, carefully built through years of mortgage bond innovation, imploded overnight. Wall Street has no mercy for big failures. Fink was pushed out. Not fired exactly, but made so uncomfortable that leaving became the only option. He spent 2 years in the wilderness, consulting and soul-searching, obsessing over what went wrong. Most traders would have blamed bad luck or market conditions. Fink blamed something deeper, risk management, or rather the complete absence of it. First, Boston had no system to model complex scenarios or stress test portfolios against unexpected moves. They were flying blind, making massive bets with incomplete information. That obsession became BlackRock's founding principle. In 1988, Fink partnered with Robert Capito, who'd worked with him at First Boston, along with 6 others. They convinced Pete Peterson and Steve Schwartzman at Blackstone Group to back them with seed capital and office space. The deal gave Blackstone 50% ownership of the new firm in exchange for resources and credibility. The name BlackRock was deliberately chosen, partly as a nod to Blackstone, partly as a reference to the black box of financial engineering they planned to build. From day one, their pitch was different from every other money manager on Wall Street. They didn't promise to beat the market. They promised to understand risk better than anyone else. Their first client was a single account, managing $5 million in mortgage-backed securities for an insurance company. The terms were unusual for 1988. BlackRock wouldn't charge the typical 1–2% annual management fee that every other firm demanded. Instead, they'd charge based on performance and platform fees. Cheaper, more transparent. You see, Fink understood something crucial. Wall Street's fee structure was vulnerable. Clients were starting to question why they paid such high costs for returns that rarely beat simple benchmarks. The mutual fund industry was getting fat and lazy, charging premium prices for mediocre performance. BlackRock's early strategy was to underprice the competition while over-delivering on risk analysis. They invested heavily in technology, unusual for a tiny startup in 1988, when most trading was still done with phones and paper. They hired mathematicians and engineers alongside traditional Wall Street types. By 1992, they'd grown to $17 billion in assets under management. Small compared to giants like Fidelity or Merrill Lynch, but substantial for a 4-year-old firm. They managed fixed-income portfolios for insurance companies, pension funds, and corporations. Boring stuff. Bonds, not stocks. Risk management, not speculation. The work was technical and unglamorous, while hedge funds grabbed headlines with spectacular returns and spectacular blow-ups. BlackRock quietly built systems. Their Aladdin platform, launched in the early 1990s, became the technological foundation for everything that followed. Aladdin stood for Asset, Liability, Debt, and Derivative Investment Network. The name was clunky, but the system was revolutionary. It could model complex portfolios, simulate thousands of market scenarios, and identify hidden risks that traditional analysis missed. The same risks that had destroyed Fink's career at First Boston. Here's what's interesting. BlackRock started licensing Aladdin to other financial institutions. Competitors would pay BlackRock to use their risk management technology. This created a dual revenue stream, management fees from clients plus platform fees from other firms, and gave BlackRock incredible insight into how the broader market operated. By the late 1990s, hundreds of institutions were running their portfolios through Aladdin. BlackRock could see correlation risks, concentration risks, and systemic vulnerabilities that no single firm could spot in isolation. They became the risk management utility for global finance, but they still weren't a household name. Most ordinary investors had never heard of BlackRock. They didn't manage retail mutual funds, they didn't advertise on television. They operated in the background, managing money for institutions while building technological infrastructure. The turning point came in 1999, when BlackRock went public through a merger with PNC Financial Services Group. The deal was structured carefully. PNC would own the majority of BlackRock, but Fink would retain operational control. BlackRock's shares began trading on the New York Stock Exchange, giving them access to public capital markets for the first time. The initial public offering valued BlackRock at roughly $900 million, a respectable sum for a specialized fixed-income manager, but nothing that would make headlines in an era of dot-com mania. While investors were throwing billions at unprofitable internet companies, BlackRock was quietly expanding its institutional business. They made a crucial hire in 2000. Barbara Novick, who'd been with the firm since the beginning, spearheaded government relations. BlackRock started cultivating relationships with regulators at the Federal Reserve, the Treasury Department, and the Securities and Exchange Commission. Not through lobbying or political donations, but through expertise. When regulators had questions about complex securities or systemic risk, they called BlackRock. When pension funds needed independent analysis of their portfolios, they hired BlackRock. The firm positioned itself as the neutral expert, trusted, sophisticated, essential. This reputation would prove invaluable when crisis hit. Look, the early BlackRock story isn't dramatic. No billion-dollar trades, no hostile takeovers, no scandals, just steady accumulation of assets, technology, and credibility. Fink learned from his first Boston disaster that flashiness gets you killed, boring gets you rich. By 2004, BlackRock managed $342 billion in assets, 65 times larger than their 1992 position. They'd expanded beyond fixed income into equities, real estate, and alternative investments. They'd acquired several competitors and integrated their assets into the Aladdin platform. But they were still primarily an institutional player. The real transformation, the move that would make BlackRock the most powerful firm in finance, was still ahead. What nobody understood yet was that BlackRock wasn't building a traditional asset manager. They were building infrastructure, a platform that could scale infinitely as long as assets kept flowing in, and they were about to find the product that would make those assets flow like a broken dam. The seeds were already planted. Index funds were growing. ETFs were gaining traction. Passive investing was starting to challenge active management. BlackRock was watching carefully, waiting for the right moment to make their move. That moment came in 2009, in the wreckage of the worst financial crisis since the Great Depression. While other firms were fighting for survival, BlackRock was positioning itself to dominate the next decade. But first, they had to survive the crash themselves. Chapter 2: The Strategy. The 2008 financial crisis should have destroyed BlackRock. Lehman Brothers collapsed in September 2008. AIG required a $182 billion government bailout. Bear Stearns evaporated. Merrill Lynch sold itself to Bank of America in a desperate weekend negotiation. The entire global financial system teetered on the edge of systemic failure. BlackRock managed $1.3 trillion at the time, enormous by any measure, but heavily exposed to the same mortgage-backed securities and derivatives that were imploding across Wall Street. If their risk models failed, if their positions collapsed, BlackRock could have joined the casualty list. Instead, they became the most important firm in the world. Here's what happened. As panic spread through financial markets, government officials realized they had a catastrophic problem. Treasury Secretary Hank Paulson and Federal Reserve Chair Ben Bernanke needed to understand exactly what toxic assets banks were holding. They needed to value portfolios of mortgage-backed securities that had no functioning market. They needed someone they could trust to analyze trillions in distressed assets. They called Larry Fink. BlackRock's Aladdin system became the diagnostic tool for the entire crisis. The Federal Reserve hired BlackRock to value and manage the assets seized from Bear Stearns, then to analyze AIG's portfolio, then to advise on the Troubled Asset Relief Program. Treasury, the Fed, and eventually foreign governments relied on BlackRock's technology and expertise to navigate the chaos. Fink became an informal advisor to the Obama administration, not an official position. BlackRock carefully avoided regulatory constraints, but a trusted voice in crucial decisions. When policymakers needed to understand complex securities, they consulted BlackRock. When they needed independent portfolio analysis, they hired BlackRock. This access was priceless. Not because BlackRock used insider information, they were scrupulous about ethical walls, but because it positioned them as essential infrastructure, too important to fail, too trusted to regulate aggressively, the firm that saved the financial system. But Fink was thinking bigger than crisis management. While the financial world was collapsing, Fink saw an opportunity that would define BlackRock's next chapter. Barclays Global Investors, the asset management division of British banking giant Barclays, was in trouble. Barclays needed to raise capital quickly after taking heavy losses in the crisis. They wanted to sell BGI, which managed $1.5 trillion in assets and owned the iShares ETF business. iShares was the crown jewel. Launched in 2000, it had become the second largest ETF provider in the world, behind only State Street's SPDR products. iShares offered over 300 ETFs, tracking everything from broad market indices to specific sectors, commodities, and international markets. The price tag was staggering, $13.5 billion. At the time, it was one of the largest financial services acquisitions in history. Many analysts thought Fink was insane. The global economy was in free fall. Credit markets were frozen. Why would anyone spend billions to acquire an asset manager when the entire industry faced existential uncertainty? Fink saw what others didn't. He understood that the crisis would fundamentally reshape investing. Retail investors who lost fortunes in actively managed funds would flee to passive index products. Regulators would demand more transparency and lower risk. Institutional clients would prioritize cost and efficiency over promises of market-beating returns. ETFs were perfectly positioned for this new world. They were transparent. You could see exactly what you owned. They were liquid. You could buy and sell throughout the trading day. They were cheap. Expense ratios measured in basis points, not percentages. And they were growing explosively. In 2008, total ETF assets globally stood at around $700 billion. Mutual funds still dominated with over $10 trillion. But the growth trajectory was clear. ETF assets were doubling every few years, while mutual fund inflows were stagnating. BlackRock closed the iShares acquisition in December 2009. Overnight, they became the world's largest ETF provider with about $400 billion in ETF assets. Combined with their existing institutional business, BlackRock now managed $3.35 trillion total, making them the largest publicly traded asset manager on Earth. The integration was massive. BlackRock absorbed 2,000 BGI employees, hundreds of funds, and complex technology systems. They had to consolidate duplicate products, navigate regulatory approvals across dozens of countries, and maintain client relationships through the transition. But the real strategic brilliance was in the structure. When you invest in a BlackRock ETF, you're not buying a collection of stocks or bonds directly. You're buying shares in a fund that owns those securities. BlackRock manages the fund. And crucially, BlackRock votes the shares. Think about what that means. A retail investor buying $10,000 of the iShares Core S&P 500 ETF, ticker IVV, gets exposure to 500 large American companies. But they don't get 500 separate voting rights. BlackRock gets those votes. The investor essentially delegates their shareholder power to BlackRock's stewardship team. Individually, that's meaningless, but when millions of investors do the same thing, BlackRock accumulates voting power on a scale unprecedented in corporate history. By 2012, just 3 years after the iShares acquisition, BlackRock's ETF assets had grown to $680 billion. They'd launched new products, attracted massive inflows from the shift to passive investing, and established market leadership that competitors couldn't challenge. Vanguard, the pioneer of index investing, had larger total assets because of their massive mutual fund business. But in the ETF space, the fast-growing, high-margin future of the industry, BlackRock dominated. The strategy was brilliantly simple. Offer the cheapest, most efficient index products possible. Make it economically irrational to choose anything else. Let the money flow in automatically as investors fled high-cost active management, then use that accumulated capital to build influence across corporate America. Here's the thing. BlackRock didn't need to pick winning companies. They just needed to own pieces of all the companies. When you own 5 to 7% of every major corporation, you don't care which specific companies win or lose. You care about the overall health of the market. You become invested in systemic stability rather than individual competitive advantage. This aligned BlackRock's interests with broad economic growth rather than zero-sum competition. It also gave them an excuse to engage with every company on issues that affected all companies: corporate governance, climate risk, labor practices, executive compensation. Fink started writing his annual letter to CEOs in 2012. The first letters were modest, encouraging long-term thinking over quarterly earnings obsession. But they established a precedent. BlackRock, as a major shareholder in virtually every public company, had a voice in how those companies operated. The letters became more pointed over time. By the mid-2010s, Fink was pushing companies on environmental sustainability, board diversity, and stakeholder capitalism. Critics called it overreach. Supporters called it responsible stewardship. But everyone had to pay attention because BlackRock controlled too many votes to ignore. Look, this wasn't altruism. BlackRock understood that their business model required public trust and regulatory acceptance. If ETFs were seen as dangerous concentrations of power, regulators might intervene. If passive investing was blamed for market dysfunction, inflows might reverse. So BlackRock positioned itself as a responsible actor. They published detailed voting records. They engaged with companies constructively rather than confrontationally. They avoided hostile activism and public battles. They were the good guys, or at least wanted to be seen that way. The iShares acquisition transformed BlackRock from a large institutional asset manager into something entirely different, a financial utility. Like an electric company or water provider, they became infrastructure that the entire system relied on. Pension funds put worker retirement savings into BlackRock ETFs. Sovereign wealth funds parked reserves in iShares products. Individual investors built portfolios around BlackRock's index funds. By 2015, BlackRock managed $4.6 trillion, more than any other asset manager in history. But the really explosive growth was still ahead. The shift from active to passive investing was accelerating. Every year, billions flowed out of expensive mutual funds and into cheap index products. And BlackRock, with its scale advantages and dominant market position, captured the lion's share. They'd cracked the code, build the cheapest, most efficient products, let them grow automatically as the industry shifts, accumulate voting power as a byproduct, use that power carefully to maintain legitimacy. It was passive investing taken to its logical extreme, passive dominance. But this raised uncomfortable questions that regulators and academics were just beginning to ask. What happens when one firm owns significant stakes in all the major companies in an industry? Does that reduce competition? Does it concentrate too much power? Can three giant passive managers, BlackRock, Vanguard, and State Street, effectively control corporate America? Those questions would become impossible to ignore in the years ahead. Chapter 3: Index Revolution. Jack Bogle started the index fund revolution in 1976 when he launched the first index investment trust at Vanguard. The financial establishment mocked him. Who would invest in a fund that promised average returns? Why pay management fees for a portfolio that just mechanically tracked the S&P 500? Where was the expertise, the stock-picking genius, the value added that justified Wall Street's existence? Bogle's answer was devastating in its simplicity. Because most professional managers underperform the market after fees. Because the average actively managed mutual fund charges 1 to 2% annually, while delivering returns below index benchmarks. Because stock picking is largely luck disguised as skill. The numbers backed him up. Over any 10-year period, approximately 85% of active mutual funds failed to beat their benchmark indices. The few that did succeed rarely repeated their performance. The evidence suggested that buying the whole market and holding it forever was the optimal strategy for most investors. But adoption was slow. The first index investment trust raised just $11.3 million in its initial offering, a humiliating flop by mutual fund standards. Brokers didn't want to sell a product that generated minimal commissions. Investors thought index funds were un-American, a surrender to mediocrity. It took decades for index investing to gain mainstream acceptance. But by the 2000s, the dam had broken. Investors burned by the dot-com crash and the 2008 financial crisis lost faith in active managers who promised to protect them. Academic research overwhelmingly supported indexing. Financial advisors began recommending low-cost index funds as portfolio cornerstones. This was the revolution BlackRock bought into with the iShares acquisition. But BlackRock's version of indexing had a crucial difference from Vanguard's model. Vanguard operated as a mutual company owned by its fund shareholders, a cooperative structure where profits flowed back to investors through lower fees. Vanguard had no external shareholders to satisfy, no profit motive beyond covering costs. BlackRock was a publicly traded corporation. They needed to generate profits for shareholders while keeping fees low enough to compete with Vanguard. This tension drove innovation in product structure and distribution. The ETF solved this puzzle perfectly. Unlike traditional mutual funds, which required complex back-office operations and daily liquidity management, ETFs traded on exchanges like stocks. Creation and redemption happened through authorized participants, large financial institutions that exchanged baskets of securities for ETF shares. This structure was more efficient, more scalable, and more profitable than traditional mutual funds. BlackRock could charge expense ratios of just 0.03–0.04% annually on flagship products like IVV and still make money because the cost structure was so lean. The technology they'd built, Aladdin and the associated portfolio management systems, allowed them to run these funds with minimal human intervention. By 2013, the index investing revolution was hitting escape velocity. Every month brought new records for passive fund inflows. Money poured out of active mutual funds at an accelerating rate. $180 billion outflows in 2013 alone, heading straight into index products. BlackRock captured roughly 30% of those inflows. Their iShares ETF business grew from $400 billion at acquisition to $1 trillion by 2014. They doubled their ETF assets in just 5 years, while the broader market was growing at 20% annually. Vanguard remained larger in total assets because of their massive index mutual fund business, products like the Vanguard 500 Index Fund that had been around since the 1970s. But in the ETF space, BlackRock dominated. They had more products, better distribution through financial advisors, and stronger brand recognition among institutional clients. State Street, the third major player through their SPDR ETF line, held strong positions in certain niches, but lacked BlackRock's scale and technological sophistication. Regional players like Invesco and Charles Schwab offered competitive products, but couldn't match the breadth of BlackRock's offerings. The competitive dynamic created a race to zero on fees. BlackRock launched a price war in 2016, cutting expense ratios on core products to match Vanguard's rock-bottom pricing. The iShares Core S&P 500 ETF dropped to 0.04% annually, meaning investors paid just $4 per year for every $10,000 invested. At those prices, traditional active managers couldn't compete. A mutual fund charging 1% annually needed to beat the market by more than 1% after trading costs just to break even with an index fund. Very few could do it consistently. The evidence was clear. For most investors, index investing was simply superior. But here's where the story gets interesting. As passive investing grew, BlackRock's ownership stakes in individual companies grew automatically, not because they were buying more shares strategically, but because more investors were buying their ETFs. When you trace the mechanics, it's fascinating. An investor puts $10,000 into an S&P 500 ETF. That money flows to BlackRock, who uses it to buy proportional stakes in all 500 index companies. Apple gets about $700 of that $10,000 because it's roughly 7% of the index. Microsoft gets about $650. Amazon gets about $350, and so on down the list. Individually, trivial, but when this happens billions of times across millions of investors, BlackRock ends up owning massive stakes in every company. By 2016, BlackRock had become the largest shareholder in Apple, the largest shareholder in ExxonMobil, the largest shareholder in Johnson & Johnson. The list went on and on. They owned these stakes not because they thought these companies would outperform, but simply because they were in the index. Their ownership was purely mechanical, driven by inflows from investors seeking market exposure. This created a strange dynamic. BlackRock had enormous influence over companies they'd never specifically chosen to invest in. They had to vote on thousands of proxy proposals each year, executive compensation packages, board elections, merger approvals, shareholder resolutions, across a portfolio so vast that detailed analysis was impossible. So they developed standardized voting policies, guidelines that would be applied systematically across their entire portfolio, principles around board independence, executive pay alignment, climate risk disclosure, board diversity. This standardization magnified their power. When BlackRock announced a voting policy, every company in their portfolio had to consider it, not because BlackRock threatened them individually, but because BlackRock's votes often determined the outcome of close proxy contests. In 2017, BlackRock announced they'd begin voting against directors at companies that didn't have at least 2 women on their boards. This single policy change affected hundreds of companies overnight, not through direct confrontation, but through systematic application of a principle across their entire portfolio. Critics started calling BlackRock part of the big 3 passive managers, alongside Vanguard and State Street, who collectively controlled over $15 trillion in assets by 2018. Together, they were the largest shareholders in 88% of S&P 500 companies. In 40% of listed companies, they collectively owned over 20% of shares. academic papers began questioning whether this concentration reduced competition. If BlackRock owned significant stakes in all major airlines, did they have incentives to encourage price discipline rather than aggressive competition? If they owned pieces of all major banks, would they push for industry-friendly regulation? The theory was controversial. BlackRock insisted they voted each holding based on maximizing that company's individual long-term value. They maintained Chinese walls between different parts of their organization. They published extensive documentation of their stewardship practices. But the math was undeniable. 3 firms now had voting power over a significant fraction of the American economy. And that concentration was growing as passive investing continued its relentless march. By 2019, passive funds held $4.3 trillion in U.S. equity assets, compared to $4.2 trillion in active funds. The crossover point, where passive exceeded active for the first time in history, marked a fundamental shift in how capital markets operated. BlackRock's assets under management had grown to $7.4 trillion by the end of 2019. They managed more money than the GDP of every country except the US, China, and Japan. They employed 16,000 people in 38 countries. They'd become a financial superpower. The index revolution that Jack Bogle started in 1976 had reached its logical conclusion. Passive investing didn't just match active management, it had surpassed it. And the firms that built the best index products had accumulated power that transcended traditional asset management. You see, BlackRock wasn't just riding the passive wave. They were amplifying it, accelerating it, profiting from it. Every article praising index investing drove more inflows to their products. Every academic study showing active managers underperforming strengthened their competitive position. Every fee cut by competitors they could match or beat, given their scale advantages. Chapter 4. Silent Takeover. The takeover happened without anyone noticing until it was complete. Traditional corporate raiders, Carl Icahn, Daniel Loeb, Bill Ackman, bought 5 to 10% stakes in companies and waged loud public battles for control. They wrote scathing letters. They threatened proxy fights. They demanded board seats, strategic changes, asset sales. Their activism was theatrical, confrontational, headline-grabbing. BlackRock did the opposite. They quietly accumulated 5 to 8% stakes in thousands of companies simultaneously. They never demanded board seats. They rarely made public statements about specific holdings. They operated through private engagement, meetings between their corporate governance team and company management, conducted behind closed doors with no press releases. The power came from scale and persistence rather than confrontation. By 2017, BlackRock had become the largest shareholder in 80% of S&P 500 companies. Not the majority shareholder, they typically owned just 5 to 7% of any individual company. But in the fragmented world of modern corporate ownership, where no single investor holds more than 10 to 15% of most large companies, being the largest shareholder means enormous influence. Here's how it worked in practice. Let's take ExxonMobil, where BlackRock owned about 7% of shares worth roughly $25 billion. That made them the largest institutional investor in one of the world's biggest oil companies. When ExxonMobil's board considered executive compensation, climate risk strategy, or capital allocation decisions, they had to consider how BlackRock would vote. Not because BlackRock threatened them, but because BlackRock's votes often determined whether proposals passed or failed. In a typical proxy vote, retail investors, holding maybe 30% of shares, don't participate. Institutional investors, holding the remaining 70%, determine outcomes. And the big 3 passive managers, BlackRock, Vanguard, State Street, collectively controlled about 20% of ExxonMobil's shares. Their votes were decisive. Multiply that dynamic across every major corporation in America, and you see the scope of influence. BlackRock wasn't controlling any single company, but they were influential in virtually all of them. It was distributed power, less concentrated in any one place, but more pervasive across the entire system. The shift happened gradually enough that most people missed it. In 2000, the largest institutional shareholders in major corporations were typically active mutual fund managers, Fidelity, T. Rowe Price, Capital Group. They held concentrated positions in companies they'd specifically chosen, and they voted those shares based on detailed analysis. By 2020, the largest shareholders were index funds who owned everything purely because it was in the benchmark. They held positions they'd never selected and voted on issues affecting thousands of companies annually. This created a strange new corporate governance dynamic. Companies used to pitch themselves to active managers, invest in us because we're undervalued, or because we have superior growth prospects, or because management is exceptional. The manager would evaluate the pitch, decide whether to invest, and monitor the holding carefully. Index funds changed the equation entirely. Companies couldn't pitch BlackRock to buy more shares. BlackRock's holdings were determined mechanically by the index. They couldn't pitch them to hold longer. Index funds hold forever, unless a company drops out of the index. The relationship flipped from courtship to inevitability. Instead, companies had to engage with BlackRock on governance issues. Not about whether BlackRock would invest, but about how they'd vote their existing shares. BlackRock's stewardship team, about 60 people by 2018, conducted thousands of corporate engagements annually, meeting with boards and executives to discuss everything from executive compensation to environmental strategy. The engagements were private and non-confrontational. BlackRock would raise concerns, ask questions, suggest best practices. Companies would explain their positions, defend their decisions, sometimes make changes. If BlackRock remained unsatisfied, they'd vote against management recommendations. But they rarely made public statements about these disagreements. This quiet approach was strategic. Public confrontations invited backlash, regulatory scrutiny, and competitive disadvantages. Private engagement allowed BlackRock to influence corporate behavior without the drama that attracted attention. Barbara Novick, who'd helped build BlackRock's government relations strategy, explained the philosophy. We're permanent shareholders. We can't sell, so we have to engage. This was true. Index funds couldn't exit positions in poorly governed companies without abandoning the index strategy entirely. Their only tool was voice, not exit. But that voice was powerful precisely because it was unavoidable. A traditional active manager dissatisfied with a company could sell their shares and move on. BlackRock couldn't sell. They had to stay invested and push for change from within. This made their engagement more persistent and potentially more effective than activist hedge funds who came and went. The silent takeover accelerated after 2015 when Larry Fink began using his annual CEO letter as a platform for broader advocacy. The 2018 letter, titled A Sense of Purpose, argued that companies needed to serve all stakeholders, employees, customers, communities, not just shareholders. It called for long-term thinking over quarterly earnings guidance. The 2020 letter went further, declaring that climate risk was investment risk and announcing that BlackRock would make sustainability central to their investment approach. They'd exit certain coal investments. They'd launch new ESG-focused products. They'd vote more aggressively on climate-related shareholder proposals. Critics exploded. Conservative politicians accused BlackRock of pushing a woke agenda. They argued that BlackRock was using other people's money, the trillions invested in their index funds, to advance political objectives that investors never authorized. Republican state treasurers threatened to divest pension funds from BlackRock products. Progressive critics attacked from the other side, arguing that BlackRock's actions were performative. Despite the rhetoric, they still held massive fossil fuel investments. They still voted with management on the majority of proxy proposals. They still prioritized shareholder returns over genuine environmental or social change. BlackRock found itself caught in a political crossfire. Their scale made them a target for anyone who wanted to fight about corporate purpose, stakeholder capitalism, or ESG investing. And because they couldn't exit positions, they couldn't avoid controversial issues by divesting. What's interesting is that BlackRock's power came not from picking sides in these debates, but from being unavoidable. No matter which political party controlled Congress, which administration sat in the White House, or which cultural battle dominated headlines, BlackRock remained the largest shareholder in most major American corporations. They were infrastructure. Political administrations change every 4 to 8 years. Cultural attitudes shift. But the underlying mechanics of index investing, millions of people putting retirement savings into low-cost ETFs, continued regardless of political winds. By 2021, BlackRock managed $9.5 trillion. They were the largest shareholder in Apple, about 7% of shares worth roughly $175 billion. The largest shareholder in Microsoft, $140 billion stake. The largest in Amazon, Alphabet, Tesla, JP Morgan Chase, Bank of America, Walmart, Home Depot, Pfizer, Coca-Cola. The list extended to hundreds of names. Their ownership wasn't concentrated in any single company, but it was pervasive across the entire economy. This created what academics called common ownership. The same institutional investors owning significant stakes in multiple companies within the same industry. Economic research suggested this could reduce competition. If BlackRock owns pieces of United, Delta, American, and Southwest Airlines, do they have incentives to encourage industry-wide profit maximization rather than aggressive competition? If prices stay high across the industry, BlackRock's total portfolio value increases even if individual airlines don't maximize market share. The theory was controversial and the empirical evidence mixed. BlackRock argued forcefully that they voted to maximize each company's individual performance, not to optimize across their portfolio. They pointed to votes supporting disruptive new entrants, opposing anti-competitive mergers, and pushing companies to compete more effectively. But the question lingered. Could one firm responsibly exercise voting power over 5 to 8% of thousands of companies? Was this concentration healthy for capitalism? Did it represent evolution or distortion of market mechanisms? Academic papers proliferated. Common ownership and competition in the ready-to-eat cereal industry examined whether Big Three ownership of Kellogg, Ayres, General Mills, and Post led to higher cereal prices. The agency problems of institutional investors questioned whether index funds had incentives to monitor corporate governance effectively. The specter of the Giant Three warned that passive concentration could undermine corporate democracy. BlackRock's response was consistent. They took stewardship seriously, published detailed voting records, engaged systematically with portfolio companies, and operated in clients' best interests as fiduciaries. They'd built the largest investment stewardship team in the industry, over 70 people by 2021, specifically to handle the governance responsibilities that came with their scale. But the criticism highlighted a fundamental tension. BlackRock's business model required continuous asset growth. More assets meant more revenue from management fees, but more assets also meant greater ownership concentration, which invited regulatory scrutiny and political backlash. The silent takeover had succeeded beyond anyone's imagination. BlackRock had accumulated influence across corporate America without hostile raids, without public battles, without the traditional tools of corporate control. They'd used the passive investing revolution to build power that was simultaneously everywhere and nowhere, pervasive but indirect, influential but not controlling. The question facing BlackRock in the early 2020s was whether they could maintain this position, whether regulators would tolerate continued concentration, whether political pressure from left and right would constrain their actions, whether their own size would eventually become a liability rather than an asset. Larry Fink had built the empire by being quiet, efficient, and indispensable. But at $10 trillion in assets under management, quiet was no longer possible. BlackRock had become too large to hide, too powerful to ignore, too important to avoid scrutiny. The silent takeover was complete. The question now was whether BlackRock could hold what they'd won. Chapter 5. Voting Power. The voting happens every spring and most investors never notice. Proxy season, roughly March through June, is when public companies hold annual shareholder meetings. Investors vote on director elections, executive compensation packages, auditor appointments, and shareholder proposals on everything from environmental disclosure to political spending to board diversity. For most individual investors, proxy voting is background noise. They receive dense proxy statements in the mail or email, ignore them, and let their votes go uncast. Retail investor participation in proxy votes typically runs around 30%, meaning the majority of individual shareholders don't bother voting their shares. Institutional investors, by contrast, vote religiously. It's part of their fiduciary duty. When you manage other people's money, you're legally obligated to exercise voting rights in their interests. So mutual funds, pension funds, and insurance companies vote their proxy shares systematically. Index funds vote the most shares of all because they own pieces of everything. And BlackRock, as the world's largest index fund provider, casts more proxy votes than any other institution on Earth. In 2021 alone, BlackRock voted at roughly 18,000 shareholder meetings worldwide. They cast votes on approximately 153,000 individual proposals. Their investment stewardship team reviewed proxy statements, engaged with companies, applied voting guidelines, and determined how to vote trillions of dollars worth of shares across their entire portfolio. Think about the scale of that responsibility. BlackRock's stewardship team numbered about 70 people in 2021. That means each person was responsible for overseeing voting across roughly 260 companies. Not analyzing each one deeply, that was impossible, but applying systematic voting policies across the entire portfolio. Those policies determined outcomes. When BlackRock announced they'd vote against directors at companies without adequate climate risk disclosure, hundreds of companies immediately enhanced their reporting. Not because BlackRock threatened them individually, but because failing to comply meant losing support from their largest shareholder. The voting power manifested most dramatically in contested situations. In 2021, a small activist hedge fund called Engine No. 1, with just $250 million under management and a tiny 0.02% stake in ExxonMobil, launched a proxy fight to replace 3 ExxonMobil directors with candidates more focused on energy transition and climate strategy. By traditional activist standards, Engine No. 1 had no chance. They owned virtually nothing. ExxonMobil's market cap was $250 billion. Management and the board opposed the activists. Major institutional investors typically sided with management in proxy fights. The odds appeared insurmountable. But Engine No. 1 ran a brilliant campaign, arguing that ExxonMobil's board lacked energy transition expertise, putting long-term shareholder value at risk. They framed it not as an environmental crusade, but as a governance and business strategy issue. And they convinced the big 3 passive managers. BlackRock, Vanguard, and State Street all voted to support at least some of Engine No. 1's director nominees. Their votes were decisive. Despite owning just 0.02% themselves, Engine No. 1 won seats for 3 directors because the passive giants, collectively owning about 20% of ExxonMobil, sided with them. The ExxonMobil proxy fight became a watershed moment, demonstrating that BlackRock's voting power could override management opposition even at one of America's most powerful corporations. It showed that the big 3, despite their passive investment approach, could be decisive actors in corporate governance when they chose to engage. But it also raised uncomfortable questions. Should BlackRock have this much influence? They'd accumulated their ExxonMobil shares mechanically, not because they specifically believed in the company or had analyzed its strategy. Most of their beneficial owners, the people who bought iShares ETFs, had no idea their shares would be voted to reshape ExxonMobil's board. They just wanted market exposure. BlackRock defended their vote as consistent with long-term value maximization. ExxonMobil faced genuine business risks from energy transition. The board needed relevant expertise. Supporting Engine No. 1's nominees was prudent stewardship, not political activism. Critics weren't convinced. Conservative commentators accused BlackRock of imposing climate politics on American energy companies. They argued that BlackRock was using other people's capital to advance environmental agendas those investors never authorized. Texas and West Virginia threatened to boycott BlackRock products for state pension investments. The backlash revealed a fundamental tension in index fund voting. When BlackRock votes shares, whose interests are they representing? The beneficial owners who bought their ETFs, BlackRock's own institutional interests, society's broader interests, all of the above? The legal answer was clear. BlackRock had a fiduciary duty to act in the best financial interests of their fund shareholders. not their own interests, not political interests, not social interests, except where they intersected with financial value. But what constitutes best financial interests over long time horizons? If climate change poses risks to portfolio companies over 20-30 years, is voting for climate-conscious directors financially prudent or politically motivated? Where's the line between legitimate business risk assessment and imposing personal values? BlackRock tried to navigate this by developing detailed, publicly disclosed voting policies. They published annual stewardship reports explaining their approach. They voted with management about 90% of the time, far more supportive than activist hedge funds. They emphasized engagement over confrontation. But the sheer volume of votes they cast meant that even their 10% opposition rate translated to thousands of votes against management recommendations annually. On executive compensation, they voted against about 15% of say-on-pay proposals. On board elections, they withheld support from roughly 5% of director nominees. On shareholder proposals, they supported about 30% of environmental and social resolutions. Each vote was small in isolation, but cumulatively, they shaped corporate behavior across the entire market. Companies adjusted compensation structures to meet BlackRock's criteria. Boards added independent directors and diversity to avoid BlackRock opposition. Companies enhanced climate disclosure to satisfy BlackRock's expectations. This wasn't because BlackRock dominated any individual company. It was because their voting policies applied systematically across thousands of companies simultaneously. They were setting industry-wide norms, not company-specific strategies. Vanguard took a slightly different approach. With over $7 trillion under management and similar ownership positions, they had comparable voting power. But Vanguard's voting was generally more deferential to management. They emphasized engagement behind closed doors and public support for management recommendations. State Street fell between BlackRock and Vanguard, more willing to vote against management than Vanguard, but less aggressive than BlackRock. With about $4 trillion under management, they completed the Big Three. Together, these three firms voted roughly 25% of shares at major U.S. corporations. In many proxy contests, their collective decision determined the outcome. They'd become the de facto arbiters of corporate governance disputes, not through intention, but through the mechanics of passive investing. The concentration worried academics and policymakers. In 2021, the Department of Justice's Antitrust Division began exploring whether common ownership by Big Three passive managers reduced competition. The Securities and Exchange Commission considered new rules around proxy voting disclosure and conflict of interests. European regulators were even more concerned. The European Commission studied whether passive fund concentration threatened market competition. Some members of the European Parliament called for stricter limits on voting rights for index funds. BlackRock responded by emphasizing transparency. They published vote-by-vote records, allowing anyone to see how they'd voted every proxy. They explained their engagement process in detailed annual reports. They offered some institutional clients voting choice options, allowing those clients to direct how their shares would be voted. But voting choice had limited uptake. Most institutional clients preferred letting BlackRock handle governance. That was part of the value proposition. And retail investors in ETFs had no practical way to direct voting on their proportional shares. The administrative complexity made retail voting choice essentially impossible. So BlackRock retained discretion over how to vote trillions in assets. They built the largest investment stewardship team in the industry, specifically to manage this responsibility. They developed sophisticated systems for analyzing proxy statements at scale. They established regional stewardship teams covering different markets and languages. By 2022, BlackRock's stewardship team had grown to over 100 people. They conducted more than 4,000 company engagements annually. They voted at nearly 20,000 shareholder meetings. They'd become the most powerful voting bloc in global capital markets, a position they never explicitly sought, but acquired as a natural consequence of index fund scale. The irony was perfect. Passive investing was supposed to be passive. Buy the market, hold forever, don't try to pick winners or influence companies. Just own everything and accept market returns. Instead, It created the most active corporate governance force in capitalism. BlackRock couldn't not engage. With positions they couldn't exit, they had to vote. With responsibilities to millions of beneficial owners, they had to vote thoughtfully. With scale that made their decisions consequential, they had to develop systematic approaches. Passive investing had generated active power, and nobody quite knew what to do about it. The voting power question was ultimately about legitimacy. Did BlackRock have the right to exercise this much influence? Were they using it responsibly? Could the system sustain continued concentration without regulatory intervention? These questions would intensify as BlackRock's assets continued growing toward 10 trillion and beyond. The voting power wasn't going away. If anything, it was expanding as passive investing continued capturing market share from active management. BlackRock had the power. The question was whether they could keep it. Chapter 6. Shadow Influence. The real power isn't in the votes you cast, it's in the votes you don't have to cast, because companies already know what you expect. This was BlackRock's shadow influence, the ability to shape corporate behavior through anticipated reactions rather than explicit demands. Companies adjusted strategies, changed policies, and modified practices because they knew BlackRock was watching, not because BlackRock had threatened them. The mechanism was subtle. BlackRock would publish voting guidelines explaining their expectations around board composition, executive compensation, environmental disclosure, and corporate strategy. Companies would read those guidelines and preemptively align their practices to avoid opposition. No confrontation required, no public battle, just systematic anticipation of what the largest shareholder would accept. Consider board diversity. In 2017, BlackRock announced they'd vote against nominating committees at companies in major indices that didn't have at least 2 women directors. This wasn't a request. It was a declared voting policy that would be applied mechanically across their portfolio. The effect was immediate. Between 2017 and 2022, the percentage of S&P 500 companies with at least 2 women directors increased from 60% to 95%. BlackRock didn't vote against hundreds of boards. Companies added women directors proactively to avoid BlackRock opposition. The shadow influence extended to climate reporting. In 2020, BlackRock announced expectations that companies disclose climate risks according to Task Force on Climate-Related Financial Disclosures, TCFD, standards. They'd engage with companies lacking adequate disclosure and potentially vote against directors at persistent laggards. Within 2 years, over 2,600 companies globally had adopted TCFD reporting, not because governments mandated it, but because major investors expected it. BlackRock's declared priorities became industry standards through anticipatory compliance. This was power operating at the systemic level. BlackRock didn't need to fight individual companies because the entire market moved to meet their expectations. It was more efficient than activism, more scalable than engagement, and more durable than proxy fights. But it also raised questions about accountability. When BlackRock shaped corporate behavior through published guidelines rather than company-specific interventions, who checked whether their priorities actually served shareholder interests? How could companies push back against expectations that seemed unreasonable for their specific circumstances? The shadow influence was strongest in areas where BlackRock's priorities aligned with broader investor sentiment and regulatory trends. Board diversity, climate disclosure, executive compensation reform. These were issues where BlackRock could position themselves as representing emerging best practices rather than imposing personal preferences. It was weaker in areas where investor opinion was divided or where business implications were unclear. BlackRock generally avoided taking strong positions on controversial social issues where their investor base had mixed views. They wouldn't mandate specific diversity targets, partisan political restrictions, or detailed operational strategies. The approach was calibrated for legitimacy. Push on issues where there's broad support and clear business rationale. Stay neutral on divisive social issues. Frame everything as long-term value creation rather than political advocacy. But even this careful calibration couldn't avoid political backlash. In 2022, 19 Republican state attorneys general wrote to Larry Fink accusing BlackRock of weaponizing shareholder voting to push environmental agendas. They argued BlackRock's climate priorities harmed American energy companies and violated fiduciary duties to maximize returns. Florida Governor Ron DeSantis announced the state would divest $2 billion from BlackRock funds, claiming BlackRock prioritized woke politics over financial returns. Further Republican-led states followed with similar moves. The political environment had shifted. What BlackRock framed as risk management, critics called political activism. The backlash revealed how shadow influence operates in practice. BlackRock hadn't divested from fossil fuels despite rhetoric suggesting they might. Their actual portfolios still held hundreds of billions in oil, gas, and coal investments. They voted with management at energy companies most of the time, but the perception of their priorities, created through Larry Fink's letters, public statements, and voting guideline emphasis on climate, had real effects. Energy companies felt pressure to address climate transition, even if BlackRock rarely voted against them. The shadow influence worked through positioning and rhetoric as much as actual voting. This created a strange dynamic where BlackRock was simultaneously criticized from left and right. Progressives said they talked big on climate, but didn't follow through with aggressive voting or divestment. Conservatives said their climate focus betrayed shareholders and pushed political agendas. BlackRock insisted they were simply managing long-term risks for clients. The truth was probably that BlackRock was trying to navigate impossible political terrain. With $10 trillion under management and ownership in virtually every major company, they couldn't avoid controversy. Any position they took would anger someone. Silence would be criticized as abdication of responsibility. Action would be criticized as overreach. Shadow influence became a liability when it attracted too much attention. The power worked best when exercised quietly, through private engagement and anticipatory compliance. The moment it became a political football, with senators questioning Larry Fink in hearings and governors divesting state pensions, the shadow influence became harder to exercise effectively. Internally, BlackRock was trying to thread an impossible needle. Their investment stewardship team wanted to push companies on material financial risks like climate change. Their government relations team wanted to avoid political backlash that could trigger restrictive regulation. Their business development team wanted to maintain relationships with clients across the political spectrum. These tensions played out in how they voted controversial shareholder proposals. On climate-related proposals at oil companies, BlackRock typically supported some, but not all, resolutions. Enough to appear engaged on climate, not enough to appear anti-fossil fuel. On political spending disclosure, they'd support transparency proposals, but not restrictions on corporate political activity. On board diversity, they'd vote against egregious laggards, but not impose rigid quotas. The voting patterns revealed an institution trying to influence without dominating, engage without enraging, lead without getting too far ahead of clients. It was a balancing act performed at massive scale with global scrutiny. What made shadow influence particularly powerful was how it interacted with other Big Three passive managers. When BlackRock, Vanguard, and State Street all had similar expectations around governance issues, companies faced collective pressure from their three largest shareholders. Even if each firm was measured in their approach, the combined signal was powerful. This coordination wasn't explicit. Antitrust laws prevented the Big Three from jointly determining voting strategies, but their public voting guidelines were similar enough that companies could identify common themes. Board independence, reasonable executive pay, climate risk disclosure, shareholder rights. These were consistent priorities across major passive managers. The implicit coordination magnified shadow influence. Companies didn't just worry about BlackRock's reaction, they worried about losing support from all three major passive managers simultaneously. That collective pressure shaped corporate governance norms across the market. Academic researchers documented this phenomenon. Studies showed that companies with higher institutional ownership from Big Three passive managers had more independent boards, lower CEO pay ratios, better environmental disclosure, and higher shareholder returns. The causation was debatable. Maybe well-governed companies attracted passive investment, or maybe passive ownership improved governance, But the correlation was clear. Shadow influence also operated through BlackRock's Aladdin platform. Remember, hundreds of financial institutions licensed Aladdin for portfolio management and risk analysis. These institutions saw how BlackRock modeled risks, what factors they considered material, and how they thought about long-term value drivers. This created subtle influence over how the broader market thought about risk. When BlackRock incorporated climate risk into Aladdin's modeling frameworks, hundreds of Aladdin users saw those risk factors in their daily portfolio analysis. Climate risk became normalized as a standard investment consideration, not because regulators mandated it, but because the dominant risk platform treated it as material. The same dynamic played out with other risks: cybersecurity, supply chain vulnerabilities, labor practices, board oversight. BlackRock's risk models influenced how thousands of institutional investors thought about portfolio risks. The shadow influence extended beyond their own portfolios into the broader market's risk assessment frameworks. By 2023, BlackRock managed $10 trillion and climbing. They'd reached a scale where their shadow influence was unavoidable. Companies adjusted behavior, anticipating BlackRock's reactions. Regulators consulted BlackRock when designing financial regulations. Central banks called BlackRock during crises. Competitors mimicked BlackRock's strategies and priorities. The shadow influence had become so pervasive that it was part of the infrastructure of modern capitalism. Like electrical grids or telecommunications networks, BlackRock's influence was invisible until you looked for it. Then it was everywhere. But infrastructure attracts regulation, and by 2023, regulators worldwide were questioning whether one firm should have this much systemic influence. Whether shadow power exercised through anticipated reactions was subject to the same accountability as explicit control. Whether passive investing concentration had crossed a threshold requiring intervention. The questions weren't academic. They would determine whether BlackRock could maintain its position or whether regulatory constraints would force fundamental changes to how they operated. The shadow influence had built an empire. The challenge was keeping it. Chapter 7. Government Ties. The relationship between BlackRock and the government isn't corruption. It's something more subtle and potentially more concerning: indispensability. When the Federal Reserve needed to understand mortgage-backed securities during the 2008 crisis, they called BlackRock. When the Treasury needed to value AIG's distressed assets, they hired BlackRock. When the European Central Bank wanted analysis of bond markets during the Eurozone crisis, they consulted BlackRock. When the Bank of Canada needed COVID relief program administration in 2020, they contracted BlackRock. This pattern repeated across decades and continents. Governments facing financial complexity turned to BlackRock for expertise, technology, and analysis. Not because of lobbying or political donations. BlackRock kept a relatively low profile in traditional political influence, but because they'd built capabilities that governments couldn't replicate. The Aladdin platform was central to this dynamic. No government treasury or central bank had equivalent risk modeling technology. Building it would take years and billions in investment. Licensing it from BlackRock was faster, cheaper, and came with expertise from the firm that invented modern portfolio risk management, so governments became BlackRock clients. This created relationships that blurred the line between private asset manager and public financial infrastructure. When the Fed used BlackRock's technology and advice to manage crisis interventions, was BlackRock acting as a government contractor, or was government acting as a BlackRock client? The revolving door between BlackRock and government amplified these ties. Former Treasury officials joined BlackRock's leadership. Former BlackRock executives took positions in presidential administrations. The flows went both directions and spanned Republican and Democratic administrations. Cheryl Mills, who'd been Hillary Clinton's chief of staff at the State Department, joined BlackRock's board. Adewale Adeyemo, BlackRock's former head of investor relations, became Deputy Treasury Secretary under Biden. These weren't scandalous moves. They were standard career progressions in the world where finance and policy intersected. But they created relationships that ensured BlackRock remained close to power regardless of which party controlled government. When Biden's Treasury needed advice on implementing COVID economic relief, they had natural connections to BlackRock leadership. When Trump's administration dealt with financial market volatility, they consulted with Wall Street executives, including BlackRock veterans. The most striking example of government BlackRock entanglement came in 2020 during the COVID pandemic. Financial markets crashed in March as lockdowns began. The Federal Reserve responded with unprecedented interventions, buying not just treasury bonds and mortgage securities, but also corporate bonds, a historic expansion of central bank activities. To execute these corporate bond purchases, the Fed hired BlackRock. The firm would advise on which bonds to buy, manage the purchase process, and operate the Fed's corporate credit facilities. BlackRock would earn fees for this service, but more importantly, they'd be administering a government program that would directly affect markets where they managed private client portfolios. The conflict of interest was obvious. BlackRock managed corporate bond funds for clients. Now they'd be advising the Fed on corporate bond purchases that could affect those same funds' performance. They held positions in companies whose bonds the Fed, guided by BlackRock, might buy. BlackRock insisted they'd erected strict ethical walls. Different teams would handle Fed work versus client portfolios. They'd recuse themselves from decisions affecting their holdings. They'd operate transparently and publish all purchases. Critics weren't satisfied. Senator Elizabeth Warren wrote to the Fed expressing significant concerns about the BlackRock arrangement. She argued the deal gave BlackRock access to privileged information and influence over programs affecting their own business. Progressive groups called it a bailout for Wall Street, disguised as pandemic relief. The Fed defended the choice, noting that BlackRock had unique expertise and existing infrastructure to execute complex purchases quickly. In a crisis, speed mattered more than theoretical conflicts, and BlackRock's scale meant virtually any experienced contractor would have similar conflicts. The episode revealed how deeply BlackRock had become embedded in financial system infrastructure. When government needed to intervene in markets, they turned to the same firm that was market's largest participant. The line between public and private had blurred to near invisibility. This created a subtle corruption of incentives. Not the crude corruption of bribes or quid pro quo. BlackRock was scrupulous about avoiding obvious conflicts, but a deeper corruption where government and private interests aligned so closely that distinguishing them became difficult. BlackRock benefited from financial stability because instability threatened their assets under management. Government wanted financial stability because instability threatened the economy. These aligned interests meant BlackRock often advocated for policies that served both their business model and public interest. But they were never quite the same thing. BlackRock wanted stability on terms that preserved their market position. Government wanted stability that protected the broader public. When those priorities conflicted, whose interest would BlackRock prioritize? The question was more than theoretical. After 2008, regulations like Dodd-Frank attempted to reduce systemic risk by imposing stricter rules on large financial institutions. BlackRock navigated these regulations carefully, supporting some reforms while pushing back on others that would have constrained their activities. They supported increased transparency requirements because transparency didn't hurt their business model. They supported stricter bank capital requirements because that disadvantaged traditional bank competitors without affecting asset managers. But they opposed proposals to regulate asset managers as systemically important financial institutions because that would have subjected them to Federal Reserve oversight. The lobbying was sophisticated and often technically justified. BlackRock argued correctly that they were fundamentally different from banks. They didn't take deposits, make loans, or engage in the leverage and maturity transformation that made banks systemically risky. Regulating them like banks would be category error, but this missed a deeper point. BlackRock's systemic importance came not from traditional financial risks, but from their influence over corporate governance and capital allocation across the entire economy. They were systemically important in a different way, through ownership concentration rather than balance sheet risk. Regulators struggled to address this novel form of systemic significance. Traditional financial regulation focused on preventing bank runs, limiting leverage, and ensuring adequate capital buffers. But how do you regulate influence? How do you limit power that comes from being everyone's largest shareholder, rather than from risky balance sheet positions? These questions remained largely unanswered as BlackRock continued growing. By 2023, their government relationships were stronger than ever. The firm had successfully positioned itself as essential infrastructure. The company governments called during crises, the expert regulators consulted on complex issues, the technology platform that central banks licensed. This indispensability was BlackRock's greatest asset and potentially their greatest vulnerability. Being essential to government made them powerful and protected, but it also made them political targets and potential scapegoats when financial systems malfunctioned. The government ties cut both ways. They gave BlackRock access, influence, and protection from aggressive regulation, but they also created dependencies and expectations. When governments hired BlackRock to manage crisis interventions, they implicitly endorsed BlackRock's systemic importance. This made future regulation more difficult. How could regulators constrain a firm they'd just relied on to save the financial system? Yet this same prominence made BlackRock vulnerable to political shifts. If public sentiment turned against Wall Street, BlackRock's government connections could become liabilities rather than assets. Progressive politicians increasingly questioned why a $10 trillion private asset manager had such close ties to public policy makers. The revolving door that connected BlackRock to government had built influence across administrations. But it also created the perception, fair or not, that financial interests captured regulatory policy, that the system was rigged to benefit massive asset managers at ordinary Americans' expense. BlackRock tried to manage these perceptions carefully. They emphasized their role serving clients, including pension funds and retirees. They published extensive reports on their stewardship activities and government relationships. They maintained that all their government work was competitively bid, transparently executed, and appropriately walled off from private business. But perception mattered as much as reality in politics, and the perception of excessive closeness between government and BlackRock was growing among both progressive Democrats and populist Republicans. Different critics, same conclusion. BlackRock had too much influence over both private markets and public policy. The government ties that had built BlackRock's empire were becoming constraints on their future growth. Every contract with Treasury or the Fed generated headlines and controversy. Every former official who joined BlackRock's leadership sparked criticism about revolving doors. Every regulatory decision that favored asset managers raised questions about whose interests were being served. By 2024, BlackRock faced a political environment fundamentally different from the one where they'd built their business. Government ties that once seemed like sophisticated influence were now political vulnerabilities. The indispensability that protected them was generating backlash. The question was whether they could maintain their position as financial markets became increasingly politicized. Whether government ties built over decades would survive in an era of populist skepticism toward Wall Street. Whether being indispensable would remain an asset or become a target. Chapter 8. Modern dominance. BlackRock crossed $10 trillion in assets under management in 2022, becoming the first asset manager in history to reach that threshold. To put that number in perspective, $10 trillion is larger than the GDP of every country except the United States and China. It's more than double the GDP of Japan, the world's third largest economy. It's roughly equal to the combined GDP of Germany, United Kingdom, India, and France. BlackRock doesn't own all that wealth. They manage it for clients. But management means control over proxy votes, influence over corporate strategy, power to shape market behavior. The distinction between ownership and management matters legally, but collapses practically when discussing influence. The scale of modern dominance is difficult to comprehend. BlackRock is the largest shareholder in 90% of S&P 500 companies. They're typically the #1 institutional investor in major corporations across every sector: technology, finance, healthcare, energy, consumer goods, industrials. When you buy products from Apple, bank with JP Morgan, fill prescriptions at CVS, buy groceries at Walmart, or stream shows on Netflix, BlackRock is the largest institutional shareholder in all those companies. They've achieved this without acquiring a single company through hostile takeover, without staging dramatic proxy battles, without the confrontational tactics that defined corporate raiders of previous generations. They simply built better products, charged lower fees, and let money flow to them automatically as the market shifted toward passive investing. The numbers tell the story. In 2010, BlackRock managed $3.6 trillion. By 2015, that had grown to $4.6 trillion. By 2020, $8.7 trillion. By 2023, over $10 trillion. The growth accelerated as passive investing reached critical mass, the tipping point where index funds became the default choice rather than an alternative. Their ETF business now manages over $3 trillion alone, making iShares larger than most standalone asset managers. They've launched over 1,400 ETFs worldwide, covering every conceivable market segment. Want exposure to Chinese technology stocks? There's an iShares ETF, emerging market bonds. iShares has it. Sustainable energy? Covered. Global real estate? Available. The product proliferation serves a strategic purpose. By offering ETFs for every niche, BlackRock captures assets regardless of where investors want exposure. Bull market in tech? Money flows to their tech ETFs. Rotation into value stocks? They capture that too. Flight to safety in bonds? BlackRock has dozens of fixed income ETFs. They've built a comprehensive system where almost any investment strategy can be executed through their products. This makes them indispensable to financial advisors who can construct entire client portfolios using only BlackRock ETFs. The convenience and cost efficiency make competing difficult for smaller providers. But the modern dominance extends beyond just asset scale. BlackRock's Aladdin platform now serves over 200 institutional clients, processing roughly $25 trillion in total assets, more than double BlackRock's own AUM. This means BlackRock's technology influences portfolio decisions across $35 trillion when you combine their own management plus Aladdin clients. Don't think about the informational advantage this creates. BlackRock can see positioning, risk exposures, and trading patterns across a massive swath of institutional portfolios. They're prohibited from using this information for proprietary trading. They've erected strict firewalls, but the strategic insight into market structure is invaluable. When BlackRock analyzes systemic risks, they're looking at data representing maybe 15% of global financial assets. No other institution, not central banks, not regulators, not competitors, has comparable visibility into market-wide positioning. This makes their research and risk assessments uniquely authoritative. The modern dominance also manifests in talent. BlackRock employs over 19,000 people globally, including some of the most sophisticated analysts, portfolio managers, and technologists in finance. They can outbid virtually any competitor for talent. Their brand attracts ambitious professionals who want to work at the industry's dominant firm. This creates a virtuous cycle. Top talent generates better products and insights, which attracts more assets, which generates more revenue to hire more talent. Competitors struggle to match BlackRock's investment in technology, research, and human capital. The scale advantages are nearly insurmountable. Larry Fink, now in his early 70s, has built the most powerful financial institution in history, while maintaining a relatively low public profile compared to banking CEOs or hedge fund billionaires. He's not on Forbes's billionaire list, despite BlackRock's success. His net worth is estimated at several hundred million, substantial but modest compared to founders of similar-sized institutions. This reflects BlackRock's structure. Fink owns about 1% of the company, with the rest held by public shareholders and employees. He's built an institution rather than a personal fortune machine. This institutional focus has aided longevity. BlackRock isn't dependent on any single individual and has developed deep management bench. Succession planning is underway. Fink has indicated he'll eventually step down, though no timeline is set. The firm has cultivated internal candidates, executives who've spent decades at BlackRock and understand its culture, technology, and strategic positioning. The transition will be carefully managed to maintain continuity and market confidence, but questions loom about whether BlackRock can maintain its dominance without Fink's leadership. He's been the strategic visionary who saw opportunities others missed: the iShares acquisition, the post-2008 government relationships, the pivot toward ESG and stakeholder capitalism. His annual letters to CEOs carry weight because they come from Fink personally, not just from BlackRock institutionally. Whoever succeeds him will inherit an empire, but also inherit its complications. The political backlash from both left and right. The regulatory scrutiny over market concentration. The tensions between maximizing assets and maintaining legitimacy. The impossible task of exercising influence over thousands of companies without being seen as overreaching. The modern dominance faces headwinds that didn't exist during BlackRock's rise. Active managers are fighting back with lower fees and improved performance. Competitors like Vanguard continue growing their own passive businesses. Direct indexing, where investors own individual stocks rather than fund shares, threatens to bypass traditional index funds entirely. Regulatory pressure is intensifying globally. The European Union is considering restrictions on voting rights for large passive shareholders. The US Securities and Exchange Commission is proposing stricter disclosure requirements for proxy voting and conflicts of interest. Antitrust authorities are investigating whether common ownership reduces market competition. These regulatory threats could fundamentally reshape BlackRock's business model. If they're forced to pass voting rights to beneficial owners, they lose the governance influence that makes them powerful beyond just asset scale. If they're restricted in how much they can own of competing companies, they may need to restructure their index products. If they're regulated as systemically important, they face costly oversight and capital requirements. Yet BlackRock's dominance gives them resources to adapt. They're investing heavily in technology, including artificial intelligence for portfolio management and data analytics. They're expanding in private markets, real estate, infrastructure, private equity, where passive index strategies don't apply and margins are higher. They're building wealth management platforms to serve retail clients directly rather than just through intermediaries. The strategy is to diversify beyond pure index products while maintaining dominance in passive investing. To build multiple revenue streams so regulatory constraints on any single business don't threaten the overall enterprise. To stay ahead of technological disruption rather than being victimized by it. By mid-2024, BlackRock's assets had climbed above $10.5 trillion. The growth continued despite headwinds. Money kept flowing into their products because the fundamental logic remained compelling. Why pay high fees for active management that usually underperforms when you can own the market for nearly free? That question, which drove the index revolution, continues driving assets to BlackRock. As long as passive investing keeps winning, BlackRock keeps growing. And as long as they keep growing, their influence over corporate America deepens. The modern dominance is simultaneously more extensive and more fragile than at any point in BlackRock's history. More extensive because they've reached unprecedented scale and influence. More fragile because that very scale attracts regulatory scrutiny, political backlash, and competitive threats. They've built the most powerful asset manager in history. The question facing BlackRock in 2025 and beyond is whether they can hold what they've built, whether their dominance is sustainable, or whether they've grown too large for markets, regulators, and society to tolerate, whether the empire Larry Fink constructed over 35 years can survive the next 35 years, or whether modern dominance becomes the prelude to inevitable decline, the way it has for every dominant institution throughout history. The story isn't over. It's just entering its most uncertain chapter. BlackRock's modern dominance isn't just about asset scale, it's about technological superiority that competitors can't easily replicate. The Aladdin platform represents roughly 3 decades of continuous investment and refinement. BlackRock has poured billions into developing risk analytics, portfolio optimization algorithms, trading execution systems, and data infrastructure. The platform processes over 200 million calculations daily, analyzing everything from interest rate sensitivity to climate transition risks across portfolios worth tens of trillions. What makes Aladdin particularly powerful is its network effects. Every client that uses the platform contributes data that makes the system smarter. BlackRock can see patterns across hundreds of institutional portfolios, not individual positions, which would violate confidentiality, but aggregate flows, risk concentrations, and market dynamics. This gives them a view of market structure that no single institution could achieve independently. Consider how this works in practice. When markets become volatile, Aladdin clients across the globe are running stress tests simultaneously. BlackRock can observe that pension funds are all checking exposure to the same risk factors, that insurance companies are modeling similar scenarios, that sovereign wealth funds are evaluating similar hedging strategies. This aggregated behavioral data provides insight into how markets might move before the moves happen. They can't trade on this information. Regulatory and ethical constraints prevent that clearly. But they can position their own risk management more intelligently. They can advise clients more effectively. They can speak more authoritatively to regulators and policymakers about systemic vulnerabilities. The technological moat extends beyond Aladdin. BlackRock has invested heavily in artificial intelligence and machine learning capabilities. Their AI Labs division, launched in 2017, employs hundreds of data scientists developing algorithms for everything from sentiment analysis of corporate earnings calls to satellite imagery analysis, of retail traffic patterns to natural language processing of regulatory filings. These AI capabilities aren't replacing human portfolio managers. BlackRock emphasizes that technology augments rather than replaces expertise, but they're creating efficiency advantages that smaller competitors can't match. A BlackRock analyst can use AI tools to screen thousands of companies for specific characteristics in minutes. A traditional analyst at a smaller firm might take weeks to accomplish similar analysis manually. The technology investments also serve a defensive purpose. BlackRock knows that technological disruption threatens every incumbent. Fintech startups, cryptocurrency platforms, and direct indexing providers are all trying to disintermediate traditional asset managers. By staying at the technological frontier, BlackRock aims to be the disruptor rather than the disrupted. They've made strategic investments and acquisitions to maintain this edge. In 2015, they acquired Future Advisor, a robo-advisory platform to build digital wealth management capabilities. In 2020, they took a minority stake in Scalable Capital, a European digital investment platform. These moves signal BlackRock's recognition that technology could undermine their business model if they don't stay ahead of it. The broader strategy is becoming a technology company that happens to manage assets rather than an asset manager that uses technology. This repositioning matters for valuation, talent recruitment, and long-term competitive positioning. Technology companies command higher market multiples than traditional financial services firms. Tech talent wants to work for innovative companies, not stodgy asset managers. By 2024, BlackRock's market capitalization exceeded $120 billion, making it more valuable than many major banks, despite having a completely different business model. The valuation reflects investor confidence that BlackRock's technology and market position create durable competitive advantages, even as the asset management industry faces disruption. BlackRock's modern dominance increasingly extends beyond public markets into private assets, a strategic shift that could define their next decade. Public equity and fixed income markets, where BlackRock built their empire, face challenges. Margins are compressed by fee competition. Growth is limited by how fast passive investing can capture remaining active management assets. Regulatory scrutiny is intensifying around market concentration. The business model that generated explosive growth from 2008-2022 may face maturity. Private markets offer different economics. Private equity, infrastructure, real estate, and private credit investments typically charge higher fees, often 1–2% management fees plus 10 to 20% performance fees. These fees dwarf the 0.03–0.04% expense ratios on index ETFs. A relatively small private markets business can generate profits comparable to managing trillions in passive strategies. BlackRock has been building this capability systematically. Their alternatives platform managed over $350 billion by 2023, making them one of the largest alternative asset managers globally. They've raised massive private funds, $12.5 billion for infrastructure equity, $4.8 billion for real estate, multi-billion-dollar credit funds targeting corporate lending. The strategy leverages BlackRock's existing relationships. The pension funds, insurance companies, and sovereign wealth funds that invest billions in BlackRock's public market funds are also allocating increasing amounts to private assets. BlackRock can offer integrated solutions, public and private exposure, managed through the same relationship, analyzed on the same Aladdin platform, with coordinated risk management. This one-stop shop approach creates stickiness that pure-play competitors struggle to match. A pension fund working with BlackRock for public equities, fixed income and alternatives faces massive switching costs if they want to move assets. They'd need to replace multiple relationships, integrate different technology platforms, and coordinate across numerous providers. Private markets also offer insulation from some regulatory concerns affecting public market concentration. When BlackRock buys a private infrastructure asset or makes a direct corporate loan, they're not accumulating ownership stakes across entire industries. The common ownership concerns that apply to passive index funds don't translate to private investments the same way, but private markets require different capabilities than passive investing. Success depends on sourcing proprietary deal flow, conducting detailed due diligence, negotiating complex transactions, and actively managing portfolio companies. These activities are labor-intensive and expertise-dependent, very different from the scalable, technology-driven model that made passive investing profitable. BlackRock is betting they can transfer their brand, relationships, and analytical capabilities into private markets, even though the operational models differ. They're hiring experienced private equity professionals, building specialized teams, and creating separate business units with compensation structures that match private equity norms. The challenge is maintaining culture and coordination across radically different businesses. Passive index fund managers think about portfolio optimization across thousands of liquid securities. Private equity investors think about value creation in specific companies over multi-year holding periods. These mindsets don't naturally align. Yet if BlackRock succeeds in building a dominant private markets franchise, they'll have created a more diversified, higher-margin business, less dependent on continued growth in passive assets. They'll have positioned themselves for a world where more capital flows into private markets as companies delay or avoid public listings. BlackRock's dominance has historically been built through institutional clients, pension funds, insurance companies, sovereign wealth funds. But the firm is increasingly focused on retail investors, where growth potential remains enormous. Retail investors hold roughly $30 trillion in investable assets across the United States alone. Much of this sits in high-fee mutual funds, inefficient brokerage accounts, or uninvested bank deposits. If BlackRock could capture even a small percentage by offering better solutions, the asset growth would be substantial. The challenge is distribution. Institutional clients come in large chunks. A pension fund might allocate $500 million to a BlackRock fund in a single decision. Retail clients come in small increments. An individual investor might put $5,000 into an IRA. Reaching millions of retail investors requires different infrastructure than serving hundreds of institutions. BlackRock is attacking this through multiple channels. They've built direct-to-consumer digital platforms that allow individuals to invest in BlackRock funds without going through financial advisors. They've partnered with workplace retirement plan providers to make BlackRock target date funds the default option in 401k plans. They've created tools and educational content to attract do-it-yourself investors. The target date fund business has been particularly successful. These funds, which automatically adjust asset allocation as investors approach retirement, have become the default investment in many workplace retirement plans. BlackRock's LifePath funds manage over $300 billion, capturing retirement savings from millions of American workers who may never actively choose BlackRock, but end up there through their employer's plan. This default positioning is incredibly valuable. Behavioral economics research shows that people overwhelmingly stick with default options rather than actively choosing alternatives. By becoming the default in workplace retirement plans, BlackRock captures assets that will likely stay for decades as workers accumulate retirement savings. They're also pushing into financial advisor channels more aggressively. While advisors have traditionally used multiple fund providers, BlackRock is trying to become the primary relationship through technology platforms that integrate portfolio construction, client reporting, and practice management. The pitch is, use BlackRock's tools and funds exclusively, and we'll help you run a more efficient advisory practice. This creates tension with other fund providers who also want advisor relationships. But BlackRock's scale allows them to invest more in advisor-facing technology than smaller competitors. They can offer better tools, more support, and lower costs, essentially applying the same competitive strategy that worked in institutional markets to the advisor channel. The retail expansion faces obstacles. Brand recognition among consumers remains lower than Vanguard, Fidelity, or Charles Schwab, firms that have served retail investors for decades. Building consumer trust takes time and marketing investment. Distribution through third-party platforms means competing with dozens of alternatives for investor attention. But BlackRock has patience and resources. They can outspend competitors on technology development, marketing, and advisor support. They can afford to price products aggressively to gain market share. They can sustain short-term profitability pressure in retail, while their institutional business generates steady cash flow. By 2024, retail investors represented a growing portion of BlackRock's asset base, perhaps 30% of total AUM, up from 20% a decade earlier. If this trend continues, BlackRock could become as dominant in retail as they are in institutions, creating a truly universal asset management franchise. No aspect of BlackRock's modern dominance generates more controversy than their approach to environmental, social, and governance (ESG) investing. Larry Fink's annual letters increasingly emphasized climate risk, stakeholder capitalism, and corporate purpose. The 2020 letter declared climate change a fundamental reshaping of finance. The 2021 letter called on companies to disclose plans for operating in a net zero economy. The 2022 letter argued that every company needs a strategy for navigating energy transition. This positioning attracted fierce criticism from multiple directions simultaneously. ACC, remarkable political achievement in polarized times. Conservative critics accused BlackRock of using proxy votes to advance environmental activism that harmed American energy companies, destroyed jobs in fossil fuel industries, and prioritized political correctness over shareholder returns. 19 Republican state attorneys general sent a letter to Fink threatening legal action for alleged breaches of fiduciary duty. Several Republican-led states, including Florida, Louisiana, and South Carolina, began divesting billions from BlackRock funds or excluding the firm from future state contracts. The conservative backlash had real business implications. State pension funds represented substantial assets under management. Losing Texas or Florida as clients could mean tens of billions in outflows. The political risk to BlackRock's business model was becoming tangible in ways it hadn't been previously. But progressive critics were equally harsh, arguing that BlackRock's climate rhetoric was greenwashing, marketing spin disconnected from actual investment practices. Environmental groups pointed out that BlackRock remained one of the world's largest investors in fossil fuel companies, holding hundreds of billions in coal, oil, and gas equity and debt. They noted that BlackRock voted with management on the majority of climate-related shareholder proposals, supporting only the mildest requests for disclosure. Climate activists organized protests at BlackRock's headquarters, demanding full divestment from fossil fuels and more aggressive proxy voting on environmental issues. They accused Fink of talking about climate risk while profiting from climate destruction. BlackRock found itself in an impossible position, too aggressive for conservatives, too timid for progressives, satisfying nobody while alienating key stakeholders on both sides. The firm's response was to emphasize investment choice and client preferences. They'd offer a range of products: traditional index funds, ESG-focused funds, climate-conscious portfolios, fossil fuel-free options, and let clients choose based on their own values and return expectations. BlackRock wouldn't impose a single view on contested issues, but would provide tools for clients to implement their preferred approaches. This sounds reasonable in theory, but faces practical challenges. Most of BlackRock's assets sit in plain vanilla index funds, where retail investors chose the product for cost and convenience, not because they wanted to make climate or social statements. These investors delegated voting rights to BlackRock without specific instructions on how to vote controversial proposals.